Welcome to Wall Street Sizing Up. We're glad you're here. Great show today. We're talking about DoorDash and its controversial IPO. Some investment bankers like it, some do not. We're going to give you the pros and cons and then our commentary on what we believe. You know we're sponsored by stocktrade.tips, stocktrade.tips. Trade before the crowd moves. So with that said, let's get started. Jake hit the theme and we're going to hit the casino and talk about DoorDash. Let's go. And we are off. We're going to talk about DoorDash today. You see on the screen there, DoorDash is at 161. It's a little bit below where it was when it IPO'd. Now, you got to understand when it IPO'd, guys, they had set the private valuation at $16 billion. You now have, it's almost close to $51 billion, and we'll come back to that. So why did everybody jump on this stock? Because the first thing that the top line says from the monthly full is that the stock surged 86% in the first day of trading. Why in the hell would it do this? I mean, we're talking about a commoditized product delivery service. The company revealed that over 1 million drivers, or what they call dashers, deliver meals and products for more than 390,000 merchants to approximately 18 million customers. DoorDash also leads the industry with a market share of 51%. Now, I am not so sure about that. So having operated two restaurant chains, our last one being five or six units, we had some franchises there, but having firsthand experience with DoorDash, they were good. They were all good, but they all had their issues as well.
Hate your hair, not likely. Yikes, 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 and let me guess, you have a great personality.
DoorDash was popular, but Uber Eats was even more popular, and Grubhub was even more popular than that. The problem became, from firsthand experience, is that Uber Eats took 30% of the delivery revenue, which is outrageous. So we just basically, the first 6 months of every restaurant, we would bring them in and we would just write that off as a marketing expense. Now, DoorDash and Grubhub we would keep around, but it seemed like Grubhub had their act together. But moving on, again, they all figured out that they needed to consolidate to get to scale. And that's what they did. DoorDash acquired Caviar, Uber Eats acquired Postmates, which is a really good move, and then Grubhub acquired Takeaway. Now again, this article says 51% is what DoorDash. I believe Grubhub is the top at 45, and then I want to say DoorDash is around 40, right? And then Uber Eats kind of bring it up. But here's the reason why I think people got excited. Now they didn't read the S1, and we'll get to that in a second, because in the S1 they spell it out.
Anna Banana would like to hear Venus by Bananarama. Banana.
B-A-N-A-N-A, banana.
In the first 9 months of this year, of 2020, the company booked just over $1.9 billion of revenue, more than triple from a year ago. Now, that did drive cost of revenue to nearly $900 million, but here's the thing. The gross profit improved 53% in the first 9 months from a year ago, when it was 40%. So, but we all know all the services were boosted by one thing, and that is the boost in revenue came in large part from a phenomenon that we like to call COVID-19. As people stayed home and hunkered down for the pandemic, they turned to DoorDash and peers like Grubhub and Uber Eats. And I get it. It's exactly what happened. And if you read their S1, which a lot of people I don't think read, and I'm reading this off of Citron Research. Now, Citron Research is a notorious short seller, right? In their S1, they basically say that their revenue has peaked. The circumstances that have accelerated the increase in total orders stemming from the effects of COVID-19 pandemic may not continue in the future. And we expect the growth rate in total orders to decline in future periods. That is just directly from DoorDash. That is what they're saying. That the revenue has peaked. There is going to be 2021 after the first 3 months, getting out of spring into early summer.
10,000 years will give you such a crick in the neck.
It's going to go down. This is what I see. So around here, we try to blame the young people who are getting together, but I've been out to the restaurants. I haven't gone in, stayed on patios, but here's the thing. Everywhere I go is packed. So when this vaccine really comes to fruition, and by that I mean that you've got the majority of the people that really need the vaccine vaccinated, it's going to be like a garden hose, a crimped up garden hose. And that pressure is built and built and built, and finally it's going to explode, and everybody is going to go out. Nobody's going to stay home. Nobody's going to do delivery. They're just not. They're not even doing it now. Right? But it will 2x that. Right? And so with that being said, the revenue is going to go down. All of their revenues, Uber Eats, Grubhub, you name it, even the local deliveries. So here's what the Wall Street Journal and the Business Insider and Bloomberg had to say. Food delivery with third-party apps like Grubhub, Uber Eats, and DoorDash is booming, but no one's making money. Why even have a business? You're not making money, right? At some point, you got to make money. I understand biotechs. It takes years and years and years, right? But for a delivery service, you can scale that. But there are a number of challenges, right? And to say that you could get autonomous vehicles involved, which is what DoorDash is trying to do, in fact, that's what they're all trying to do, you still have to have a guy run in and then a guy run to the door. So you're still going to have to pay somebody a living wage, right? So I think that's a scapegoat when they try to tell you that, oh, well, we're going to have autonomous vehicles, and that's just, I think that will improve margins, but when your margins are 1, 2, 3, 4%, which because this is a race to the bottom, so at some point that's what they're gonna be. Moving on, food delivery looks like another gig economy dead end. There is no money in bringing meals to customers. I feel the same way. The only guys who I think they can really make money in this is if you own the market and you can boost what you charge the merchants, right? DoorDash is around 21 to 23. Grubhub is about 25. Uber Eats, like I said, is at 30%. We just wrote them off, right? I'll even go this far. Amazon in late 2017, when we opened our second chain, our first unit, they came in and they wanted a piece, and they were the low-cost provider. They couldn't even get a dent in the market. In 2019, they came back and tried to get in the market again and couldn't do it. And guess what? They just shut down the entire delivery operation. They knew there was no money in that. And this is Amazon. They're notorious for losing money for years.
At first, we didn't know what to do with all the money. We tried burying it, shredding it, and burning it.
If they see a market there, they didn't see a market. They got out and they're done with it, right? So again, a race to the bottom. One other thing that I want to bring to your attention is too, DoorDash's direct competitors, which is, the Grubhubs and the Uber Eats, they all trade in a range of 3x to 6x of their revenue. You know what what DoorDash's is? 19x. Unsustainable. Just completely unsustainable. When you had a $16 billion valuation and nothing has changed except the pandemic, and you're 3 times more expensive when you go public, you don't think that's going to come crashing down? I certainly do. So I think you know where I stand. In conclusion, this is what Citron says. With the numerous IPOs and SPACs hitting the market and giving investors the opportunity to bet on space, EVs, and other disruptive technologies, we don't see how a food delivery business can maintain a valuation of over $50 billion. And they put a price target at $40. Again, $40, it's at $160 today. The highest it's been is 189. But hold on. There's something else. Susquehanna has come out and said, no. We think it'll go to 185. So this is what I say to that. And in fact, on Yahoo Finance, I see a 1667. So there may be some short-term upside in the next 90 days until we get out of the true pandemic, is what I like to say, to where enough people are vaccinated to where people literally want to live their lives and do not care, and they will go out, and your favorite restaurants will be literally, for 6 months, you probably cannot get a reservation. That's the way I see it from personal experience. There is some short-term upside here, but it's not going to go much higher than 160. Like I said, 167, 175, but come end of spring, it's going to drop like a rock. And that is my prediction. So hopefully you've stayed with us this long. You know where I sit. I'm not going to own DoorDash. I do not believe in food delivery businesses. I do believe in supporting local food delivery businesses, and that's what I will do. But as for DoorDash and Grubhub and Uber Eats, again, a race to the bottom, and it's not a good long-term stock. I even bet it might not even be a good short-term stock. But again, I can see a little bit of pop there. But with that being said, guys, I hope this helps. I hope you see my point, and we'll see you next time. Watch your six. Go hard in the paint. Cheers. Well, good day, good evening, and whatever time it may be. We hope you enjoyed that video as much as we enjoyed making it. Please hit the like or the subscribe or leave a comment, because we love that feedback. And you know what we say. At the casino, you got to watch your six, and you go hard in the paint, guys. Cheers. We'll see you next time.